We've got a couple slides that we're going to talk about today, and I guess our theme here, just to set the table, is 3 timeless principles of investing.
Yeah.
Today we've got Charlie with us. He's an advisor at Vector Wealth. You've been an advisor for many years. I forget how many.
Yeah, I started in the industry in 2008. So what is that now? 16 years? Pretty much right before
The big great,
lot of
the Great
things
Recession,
happened.
and or that financial crisis, GFC. I think that's what they call it.
Yeah, the Great Financial Crisis.
That's it. Yep, everything's got to have a good name.
Yeah.
But we're not here to talk about that. I mean, certainly it sets a bit of a backdrop to it and gives some history. But we've got 3 timeless principles of investing. Principle 1, don't try to time the markets. And why is that principle number 1?
It can be very tempting to want to try and time the market when you feel like maybe the market has gone up quite a bit or it's gone down. Maybe it provides some opportunity one direction or the other. But to be able to time the market it is extremely difficult to do. Let's say you think it's towards the top. You're going to sell something. But then decision part 2 is, well, what are you going to buy in its place? So not only do you have to get the sell right, you have to think about the buy.
Mm-hmm.
And then secondarily, it's, well, when is the time to get back to eventually buy what you had just sold previously, and over what time frame? What are the factors that you would be looking at that would say now is the right time to do that? So there's a lot of decision points to get right. And when we look at the market and the performance, thinking of this chart that we have pulled up here, if you are fully invested in the market the whole year, and then on average, it shows a 9.7% return.
Mm-hmm.
But if you happen to miss just the 10 best days in the market, you've cut your return nearly in half on average. And to think of 10 days of trading in a full year where there's, I think it's 252 days of trading in any given year.
Right, we got nights, weekends, holidays.
Yeah, exactly, right. So 365 days in a year, but trading-wise, we only have about 252 days.
Mm-hmm.
And if we take 10 days out of those 252 days, that's really 4% of your trading days that you're missing.
And that you've got to nail it. Just, if you want that above 9.7% on average return.
Yeah.
If you try to time it on your sell, you try to time it on your buy, you try to figure out how long to hold, how much should I have pulled out, how much should I put back in? A lot of questions. And can those sort of questions and sort of playing the tea leaves there, can you beat 9.7 in that game?
Right. And staying invested or time in the market than trying to time the market.
That's the phrase, right?
Yeah.
Time in the market beats timing the market.
Yeah.
We've got a slide here. Slide's titled Time Diversification Volatility of Returns. And maybe start just kind of on one side, especially for those just joining us on audio. What are we looking at?
Yeah, we are looking at a chart. Again, like you said, Ezra, time diversification and then volatility of returns over time. So we're looking at a chart that shows equities, stocks, and returns over a 1, 5, 10, and 20-year time frame. And it shows the highest return and the lowest or the worst return.
Okay, so a range for stocks, a range for bonds, and then a range looks like for a split, like a portfolio of a blend. Yeah.
Yes, a blended portfolio, 60% equities, 40% bonds or fixed income. And so when we look at this chart, in the 1-year time frame, looking at stocks, just 100% equity allocation portfolio, the best year is a positive 57% or 52%.
Yeah.
And so that's really high, but on the other end of the spectrum, the worst return is negative 37%.
So we're looking back at the last, I think, again, I'm going to do public math here, 73 years. And so we're saying the average annual total return is within this range over the last 70 some years.
annual returns, the best one is 52%.
Kind of an outlier. Like
Yep. And then the worst is 37.
Right.
So it's to show that all returns for stocks have fallen within that range.
Mm-hmm.
And then the average from the last slide is 9.7.
Yeah.
Yeah.
Right. Yeah, that's indeed.
Okay.
That's a good point.
In any year, there are a wide range of outcomes for stocks and their returns, anywhere from a positive 52 down to a negative 37. On the other end of the spectrum, you think of bonds and fixed income and being more conservative, the less volatility, therefore less risk. Well, it's showing in a 1 year frame, the best return was 33%, and then the worst return was negative 13%. So the range of outcomes for fixed income, it's still a wide range,
Right.
but it's not nearly as wide of a range as people experience, investors experience in the stock market.
Right. Moving out on the year. So if we're moving on, does it be the X, the sideways? So moving into the 5-year rolling or the 10-year rolling, I think you used the word the other day we were looking at these slides, I think convergence, right? So the ranges start to kind of narrow the further out you go, at least on sort of an average.
Yeah, absolutely. So if we look at the 5-year rolling, yes, there is a wide range of outcomes here. Look at stocks, negative 2% average annualized in a rolling 5-year, a positive 29%. But that convergence over time really narrows in your range of outcomes. And then very similar with fixed income, positive 18%, negative 2% on the low side.
So when you're speaking with clients or potential clients, and you kind of have this chart in mind, how does this sort of help you kind of, I don't know, build the case for a certain way of investing?
I really think about two pieces. So one, time. This is to show with time you can experience returns by participating and staying invested. Part two is that diversification, the value of diversification, especially over in a long period of time.
The next topic, just to keep us moving along here, you had titled it "Risk Comes in Different Forms," and I think, Charlie, you've said that a lot of people think that it's market risk. It's that risk of, just as that last slide had, of a negative 37%. It's a risk of losing, somewhere in a range, but still losing a great amount. If it's $1 million invested, 370,000 is incredibly hard to swallow.
Yeah.
Right?
Absolutely.
That's super meaningful.
Yeah.
So that's how I think about risk, in one way. But there's more to it than that.
Occasionally, clients come to us with a portfolio. Maybe it's due to an inheritance. Maybe it's due to employment. They may have an individual stock or a few stocks in their portfolio that they have a high concentration towards. More in that 10% or higher range of the total portfolio assets. That's really where we start looking at thinking that that's a fairly concentrated portfolio that we want to be mindful of.
I think about, certain individuals are going to have different types of accounts, from a brokerage account to a 401k or a Roth or various, right? So I think knowing which account to draw from and when is also part of that equation.
So yes, do you have a brokerage account? Do you have IRA assets that are all pre-tax? Is there Roth assets? And how are we going to efficiently provide that income for your income needs tax efficiently?
What else should people think about, or what's the kind of final takeaway here?
In summary, number one, time. Time in the markets is more important than trying to time the markets. The second thing is range of outcomes. There are a wide range of potential outcomes that the markets may provide in any given year, but that's the reason why we're trying to stay time in the market rather than trying to time them, is because we give ourselves as investors the highest likelihood to be successful and to experience positive market returns. And then third is there are risks, and yes, and there are risks beyond just the markets.
Awesome. Thank you, Charlie, for coming in and kind of giving us a kind of a quick 1, 2, 3 principles. They're all sort of connected to each other, and I think maybe for those listening who want to talk to Charlie, just certainly give a call and call Vector Wealth or visit our website, vectorwealth.com, and to learn more.
Thank you, Ezra. Appreciate it.
Thanks, Charlie. Hey, thanks for listening to our podcast. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Be sure to consult first with a qualified financial advisor and/or a tax professional before implementing any investment strategy.